It's hard to know what they're really trying to achieve. It's hard to know what their tactics are going to be going forward. It's hard to know the extent to which the administration and Donald Trump in particular is prepared to row back.
Hello, everyone, and welcome to this special edition of the Personal Investor Podcast. I'm here with Tom Stevenson, Investment Director here at Fidelity, and we're going to be answering your questions today. This is something that we do every few months as part of the activity surrounding our investment outlook, which has been published this week. We're going to answer as many questions as we can in the next half hour or so. Tom, welcome along. It's your job to pull together the investment outlook each quarter. It's a snapshot of your view of the market, and I'm going to give people some details of where they can find that at the end of the show. Boy, we couldn't have timed this better or worse, depending on your point of view. It's an interesting time if your job is to forecast where markets are heading.
Yes, I mean, yeah, you're right. I mean, we couldn't have timed it better from the perspective of people wanting a fresh take on what's going on in a fast changing world. We couldn't have timed it worse from the perspective of someone who has to actually write write this. Yeah, I mean, it's been an interesting week. I mean, and the world was already changing actually in the first 3 months of the year.
Indeed,
We were
yeah.
seeing something of a rotation away from the markets which had led towards other markets. And then, of course, a week ago in the Rose Garden, everything was torn up and thrown in the air.
Yeah, and let's just say that we are talking in a period of extreme volatility. Recording on Tuesday, we've had big falls for the last 3 days in markets. Seems to be something of a recovery, somewhat tiny amount this today. But let's face it, by the time people watch this, things are going to have changed again. And we would just ask that people sort of, view it in that context. It's difficult to be bang up to speed with this stuff. Let's not waste any time, Tom, and get straight into these questions. I'm going to add here that these are your view of the market. It is not investment advice. It should just be seen as guidance. That said, let's put some of these questions to you now, Tom. Is the US heading for a recession? Does the fallout from tariffs require a complete rethink of everyone's 2025 outlook?
Well, I mean, the evidence is that the U.S. economy is slowing, was already slowing. So the activity indicators, particularly sort of on the industrial side, on the consumer side, was already slowing down. Everything, of course, has changed with the tariffs because we just don't know whether they'll be implemented, the extent to which they'll be implemented, how long they stay in place
Yeah.
for, who's going to be affected. So, there's a huge degree of uncertainty about the health of the economy and whether we're heading towards a recession. But, internally, our current base case, which we assign a 50% probability to, is for stagflation, so a sluggish economy or slowing economy with persistent inflation. 40% chance attached to just a cyclical recession. So basically 90% chance of not a particularly great economic outcome.
Yeah, and that's echoed all over the place. The headlines are full of sort of new forecasts for recession in the US. But all of those forecasts, including ours, and I'm sure we'd admit this, come with a big asterisk next to them, which is that a lot of this could go away tomorrow, depending on what happens in the White House, frankly. And look, it's not our place really. We're not here to kind of pass judgment on the kind of politics of this, but we can say, I think, how the market's interpreting it. And if we just spend some time on that, clearly there's this huge binary sort of possible outcomes at the moment, because if tariffs stay in place, I think that many people see that as inflationary in the short term, a big hit to growth in the long term, not just in the US actually, by the way, but probably globally. And that's where recession comes about. But let's face it, the messages from the White House have been very, very mixed on this. It's hard to actually ascertain their real objectives here.
It's hard to know what they're really trying to achieve. It's hard to know what their tactics are going to be going forward. It's hard to know the extent to which the administration and Donald Trump in particular is prepared to row back on on a position which he has
Hmm.
set out very clearly and very, very strongly. We got a sense of this yesterday in the markets, that there was just a sniff. There was just a
Of a delay.
story of a delay, a 90-day delay to the implementation of the tariffs. And there was an immediate reaction
Yeah.
in the market, and huge swings. The intraday swings yesterday were something that we haven't seen um, probably since the early days of the pandemic.
Yeah.
But they were really very, very extreme. And what it's suggesting is exactly what you outlined there, that we've got this binary situation, which makes it very difficult to know how to act. Because if the tariffs stay in place as laid out, then the market will probably go down further.
Yeah.
But if there is a rowing back, if there is a sort of flexibility, some sort of compromise, then I think that there's a lot of pent-up energy that will drive the market forward.
Absolutely. I think that we've got this situation at the moment where it's sort of tailor-made for sort of volatility, because before the confirmation of the tariffs and the big dramatic falls that we've seen, there was like a month or 6 weeks longer, really, where the talk of tariffs was swirling. The market was selling off, actually.
Yeah.
For a long time. I think a lot of people would have sold off. A lot of people think, well, I'm going to take money off the table. Then the big falls come over the past week or so, and there's a lot of money out there on the sidelines, and people really desperately waiting to jump back in. You mentioned the pandemic. I'm not sure how useful that experience is going to be, because in people's minds, it's like, well, that was a big fall, 25% fall or something, and it came back in a few months. And wouldn't it have been great to buy that dip? That might be how it plays out, or it might not. It's just impossible to know.
Yeah, and I mean they're very different. Those two situations are very different. And actually, you're right. You identified that the market had been anticipating that something was going to happen. We knew that the tariffs were coming on the 2nd of April. We didn't know what they would look like, but the market peaked in the middle of February. So it had been at least the US market had been rolling off since the middle of February. And I think that's a key difference, because you said that people had sold. I don't think people had actually sold. I think a lot of people had rotated their money out of the US and maybe into other markets. Europe started to look interesting. China started to look interesting. And then when we got the big tariff shock, which was a broad-based shock, it brought everything down. So it didn't really matter whether you'd moved from the US to Europe, you still felt.
Yeah, and just finally, before we move on to other questions, which are also going to obviously cover the volatility and the tariffs somewhat, but trying to gain this out is really difficult, because the messaging from the White House just makes it impossible to truly ascertain what's going on, because the Trump is sort of projecting strength on tariffs. We're not going to back down, but we also know he's talking about negotiation. If he talks about onshoring manufacturing back to the US, well, if that's really your aim, then you have to create a lasting incentive for that to happen, a disincentive really for US consumers to buy from overseas producers, therefore creating an incentive for manufacturers to re-onshore jobs and factories and what have you. But those are long-term investments. They need to know that these tariffs are going to last actually way beyond Donald Trump, probably, into future presidencies in the US. Is that going to happen? We don't know. And at the same time, we're hearing, well, we're going to invite people to come and, we want them to be first in the queue to negotiate with us. Well, if that is your aim and you want to get better terms on, food standards or car standards or whatever it is, non-tariff barriers, well, that means you're going to have to give something up for your overseas partners to give you those concessions. And therefore, you don't get the incentive on manufacturing and onshoring anyway. It's confusing.
It's very confusing, because not least because Donald Trump is at the same time inconsistent. He says one thing and then a day later he says something completely different, or he hints at one thing and then says something different, or people around him say one thing and then he says something. So that's very inconsistent and confusing. But at the same time, he's also quite consistent. He has been talking about tariffs and trade in exactly the same way for 40 years.
Yeah.
He took out a full-page advert in the New York Times, I think, in the 1980s, berating the the US government for the position that it was taking, and the way that he perceived that Japan at the time, Japan was the China of the
Yes.
time, was ripping off the US. He hasn't changed one bit. He's got a 19th century view of global trade and he doesn't like global
Yeah,
trade.
and the thing, the thing that's probably most true in his position, he doesn't like that Europe doesn't buy American cars or American farming produce. Um, yeah, he's annoyed by those things. So actually, all the stuff about the onshoring of manufacturing jobs, I think that might be sort of retrospectively justifying his views. Really, it's actually these deficits that he's really concerned about, and so maybe
Hence the calculation of the tariffs, which was totally based on those deficits.
Yeah, and it would lead, we're trying to be as sort of rational as we can be. That would lead you towards assuming that it's the negotiation that he wants, and that the tariffs are a bargaining chip, and actually in terms of will they stay there, will they really drive into us all into a big sort of 1930s style depression? Maybe not. The odds are suggesting, but we don't know anything. But
yeah, he's completely transactional, and which leads you to think that this is a negotiating ploy. That in a way that's a relief, because you think, well, okay, these tariffs are not going to be hanging around at this level in the sort of mid-20s. US tariffs are not going to go from 2.5% to 24% and stay there, which is just as well, because that would be pretty catastrophic, I think, for the global economy. It's not going to stay like that, but it's also not reassuring because it's so changeable. You don't know how it's going to pan out.
Okay, well, let's move on, Tom, because there's probably much more space for us to talk about these things in the other questions. The next question is this: 50% of the value of both my Fidelity workplace pension and SIP is invested in the US market. Should I stick to that, given the fall in all markets recently? So lots of people are going to be asking this question. What do they do in terms of shifting their portfolios after big movements?
Yes. Well, I mean, just in terms of the balance of your investments, first of all, I mean, I think, a 50% exposure to the US is not unreasonable, given the contribution of the US stock market to the value of the global stock markets, which is probably about 70% actually. So 50% is not stupid. It's quite sensible, probably. But that's on a sort of long-term strategic point of view. But on a short-term, sort of more tactical point of view, even before the tariffs, we were seeing this rotation out of the US for a variety of reasons. One of which was valuations. The US stock market was much more highly valued. It was vulnerable to changes in the global economy, and other markets actually looked cheaper and interesting, and with some interesting growth potential, in whether that's in Europe with the sort of defense and the infrastructure spending, whether it was in China with the stimulus for the consumption in China. So I think that rotation was happening, and that would probably argue for weighting your portfolios slightly less towards the US and more towards other markets. But I don't think I would be making massive changes in my basic allocation, because I think that you work out what that's going to be, and then ups and downs in the market shouldn't really change your basic investment allocation. What was the second part of the question?
Should I stick to that given the fall in all markets recently? Yeah, just simple as that, really.
So I don't think so. I think that asset allocation, you should have a long-term sort of broad strategic asset allocation, which suits your level of risk tolerance and also suits the reality of global markets.
Yeah, and basic principles like trying not to lock in losses by selling assets after they've fallen in value.
Yeah,
I mean, we've been speaking there about the uncertainty around the US market, but it's sold off, and we still think it's going to be an attractive market at some level. It's only really if you think that the US is going to fall much further. But that's as we've said, a very binary gamble at this point.
Yeah, and so you mentioned basic investment principles, and I think that's an important one. Is the timescale of your investments? If you're a long-term investor, that is the context in which you should see the current movements.
Yeah.
If you're still working, if you're still saving, this is a blip that in due course will fade away.
Yeah.
You'll still be able to see it, but it will be less important to you.
Yeah.
Obviously, if you're at or in retirement, it's a different question.
Yeah, indeed. Well, look, lots of the questions touch on similar things, but the next question, Tom, is this. What percentage of a portfolio should be put into safer assets, such as gold and bonds, etc., to offset the present volatility of equities? Again, we've got this question about selling after movements, but what's your answer?
Well, yes, and I think the evidence is that that you should be very careful before taking decisive action in the wake of a big movement. I mean, we have lots of historical, statistical evidence that the best days in the market very often follow hot on the heels of the worst days in the market. Had you sold on Friday afternoon or Monday morning, the chances are that as we've seen today, we've seen something of a recovery in the market. And the problem with missing out on those better days in the market is you're not just missing out on that 1.5-2% gain that you got on that day. You're missing out on the subsequent gains on those gains that you've already made. So it has a very significant impact on the long-term returns that you can achieve in the stock market if you jump in and out and don't time it to perfection, which of course we can't do.
Yeah, and the question was asking about safer assets, gold, bonds. I think lots of people may find that their asset allocation has skewed over the past few years towards equities. It's sort of, it's hard. How that can happen. Just sort of slowly, gradually. Equities done better. So if you're not rebalancing, you'll just have a higher proportion in them as they grow in value. And then you've got to make a decision to go back into other assets. Gold's actually very highly priced at the moment.
Yeah.
But it is a question in the future going forward, if we can see through this current volatility, has the case for a different asset mix grown?
Yes, and I don't think it has, actually. I think it comes back to my previous answer about deciding what is an appropriate asset allocation for your risk tolerance and sticking with it, regardless of what's happening in the market. But you're absolutely right. I think there is a temptation. It's not just that the value of your shares have gone up, and so that's increased the proportion. I think over time, in a bull market, there is a temptation to think when you're looking to say invest this year's allocation for your contribution to your ISA, to look back over the last year or 2 years and say, well, those US shares have done well. I think I'll put in X% in. So there is you drift towards the recently performing assets,
and you lose patience with things that haven't performed. I mean, how often have we done these things where people say, like, when will my bonds show their worth? Is the case for bonds over? And then now, of course,
and that's precisely when you need them.
And now they've shown their value, but they would have been a drag on performance. And the hard thing is about diversification, it means living with underperformance, but certainly sort of suboptimal performance.
Yeah, you've always got something in there that's not doing very well.
Exactly, that's the point, because now a period like now comes along and it shows its worth. So always a case for getting that mix right, and a kind of like risk appetite, sort of intellectualized basis for getting what's going on with prices, right? Yeah,
absolutely. Get a sort of the theoretical balance. And the time to do that, of course, is not at a time like now. The time to do that is when markets are calm and you're calm
and everything's moving in a narrow range.
And then you just think about it, get it right, and then live with it through these moments of turbulence.
Okay. Another gold-related question, Tom: is it worth investing in gold mining shares in the current turbulence? I don't know if you've looked at the performance of gold mining shares. They've actually done even better than the gold price itself, I think.
Yes, which is what you would often expect to be the case, and has not been the case
Mm.
in the recent past, and that's partly been to do with inflation. That the rising inflation has hit the cost base of miners,
Yes.
and so they've actually lagged the performance of the gold
Yeah.
market. Inflation has now come down, so that in a way normal services resumed a bit. So there is an argument for investing in the gold metal itself, through something like an
Yeah.
ETF
And that will
or
give
through
you.
miners. And I, just from a personal anecdotal perspective, I actually do both
Okay.
because I don't know which is going to
And it's
outperform.
always annoying. You always get
Yeah.
caught on the wrong side of it, as I
So
have
I've got
been.
a gold allocation within my portfolio, and I just divide it between some miners and some gold.
Yeah. And will you just allow me? This is the sort of the effect of the gold price on gold miners is something I have to relearn every time I look into it. So will you indulge me trying to explain this difference? So imagine, Tom, you've got a gold miner who has to spend $50 to produce $100 worth of gold.
Yeah.
That's their business model.
Yeah.
Spend $50, get $100 of gold out the ground. If the gold price goes up by 50%,
Yeah.
suddenly their $100 of gold jumps to 150.
Mm.
Their costs are still 50,
Mm.
so they suddenly got a profit that's gone from 50 to 100. So the profit has doubled, even though the price has only gone up 50%.
Correct. That is how
I'm
leverage
thrilled.
works. You've explained it very clearly.
Yeah, exactly. And so that's why they're often more volatile. And that's actually what we've seen this year.
Yeah.
They've kind of reverted to that pattern.
Yeah.
And people have ploughed back in. But as you said, there was a long period, wasn't there? Sort of, inflation, commodity inflation, all that sort of Russia-Ukraine stuff when we expected miners to do better.
Yeah. And they were quite
they didn't.
disappointing.
Yeah, they didn't. Okay, well, that is the difference. Okay, the next question, Tom, is this. I'm a beginner investor and I have two questions. One, how can you choose a global diversified stocks and shares investment fund in an ISA when funds are so heavily weighted towards the US? And number two, what are good defensive investments? And then he says something impolite about Donald Trump, so I'll leave that bit out. But okay, so number one and number two, basically asking how can you be diversified when weightings are so big, so weighted towards the US? Kind of touching on what we were.
Yeah. And it's a very good question, and everyone should be aware of what's inside their investments, because many people will be invested in a global fund, probably a global tracker fund, and maybe unaware that 70% of the value of the investments within that fund will be US based investments.
Yeah, and let's just cover the logic of why that is, because it's the same in terms of how global funds divide up the whole world geographically, but it's also the same logic in how an index fund is put together on an individual market. It's basically assuming that the bigger the company, or the bigger the country in a global context, the bigger the company in an index, the more of that you want. It's a bigger, higher value company, so presumably that will be more stable. You want more of that. It's a fair assumption to make that you want more of that than you do in potentially much smaller, maybe more volatile assets. Is that a fair logic?
Well, that's how it works, but whether that's what you actually want is another question, because you could argue the reverse, which is that actually when you're investing, you want more of the smaller, less popular, more cheaply valued stocks which have the potential to grow. And there are ways of doing that. I mean, you're right that most global tracker funds are what's called market capitalization based. So they are based, the holdings within the fund are based on the size of those holdings.
Yeah.
So bigger company represents more of the value of the fund. Not all tracker funds have done that. There's another way of slicing and dicing the market, which is called the equal weighted approach, which basically takes, you've got 500 companies in the S&P 500, you invest the same amount of money in each of those 500, so 0.2% in each of those 500 companies, and by definition you have a lower or a lower exposure to the big companies and a bigger exposure to the smaller companies than you would in a market capitalization based fund. Now, there's been a lot of talk about that recently because the big companies have been also the most highly valued and most expensive companies in the market, and that made some people nervous. And that was part of the story about this rotation out of the US into the rest of the world.
Mhm.
So some people, myself included, invested not in a market capitalization based tracker fund, but in an equal weighted fund in for the S&P 500. Hasn't necessarily worked in the short term, but it might do over the longer run.
Yeah. Okay. And there's the second part to that question, which is about defensive investments. I mean, we looked at bonds. I mean, they're inherently less risky than shares. I mean, gold actually isn't inherently more or less risky, is it? It's just an asset that has a value and that changes, and it can often be a kind of hedge in very extreme periods of volatility.
Can do. I think it's as volatile.
Yeah.
In fact, it's probably more. No, it's probably as volatile as the stock market. It moves in a different way. So put it together with the stock market investment, and it can make the total
A bit
smoother. And that's really what we're talking about. I think, when we're talking about defensiveness, I think we're talking about getting a balanced portfolio, smoothing out the ride. And the way to do that is to diversify across different countries within the stock market, but also across different asset classes. So you mentioned bonds; they behave differently from shares. Gold does, property does. But even within the stock market, there are different approaches. You can focus on what's called a growth share approach, which is buying companies where in anticipation of good times in the future, growth in the future. Or there's a value approach, which is looking for more out of favor, cheaper stocks where the value is closer to hand. So you can have that kind of mixture.
Dividends would be another way of approaching this, and there are industries which would be your classically defensive industries, i.e., less affected by economic boom and bust. Consumer staples. The companies selling us toothpaste or tomato ketchup or the things that we're going to buy.
Whatever's happening in
whatever's happening, and particularly if those companies are then churning out regular dividends, very attractive, isn't it? When the world is looking uncertain, companies like that actually makes the UK potentially quite attractive.
Yeah, it does, because the UK as a market has a higher dividend yield than most other markets around the world, and companies which are paying sustainably a high dividend tend to be less volatile. They tend to respond less to falls in the market. They tend to maybe rise less in the good times as well. But that can provide a good a smoother ride for investors.
Okay, well, let's move on for now, Tom. Given the suggestion, Tom, by many investors to increase European equity allocation while reducing US exposure, what are some effective implementation strategies? Should this shift be executed at once or incrementally, and is it advisable to make such a change following a market downturn? We have covered some of this, but for just how to implement portfolio changes.
I mean, I think that's the interesting part of the question, actually, and I think generally speaking, I would say that all changes in your investment approach, whether that's just adding new money into your investments or actually changing where you're invested, are sensibly handled over a period of time. Doing things all in one go, I think, makes you vulnerable to the sort of the emotional, the psychological biases that we have to follow the herd, to respond to the news flow, to become more bearish as the market falls and to become more bullish as the market rises, all of which are counterintuitively the wrong thing to do. And I think by mechanizing our approach, by doing things steadily, so let's say I want to reduce my 50% exposure to the US and my 10% exposure to Europe, and I want to make that 30-30.
Yeah.
Do that over a year.
Work out a way to do it gradually. Yeah.
Yeah, just move it incrementally.
And lots of people will have a version of this in their head at the moment. Lots of people actually will be looking for buying opportunities given the market falls, and they're going to thinking, well, what's the best way to do it? And mathematically, there's no way of knowing the best way of doing it. It might work for you to do it all in one go, but you don't know that it will, and it creates a lot of your sort of range of outcomes is much wider, isn't it? When you do it in increments, particularly when you sort of automate it, if possible, it's going to, you know, you can just rest it a bit more easy. I was reading something very interesting, just saying, you know, if you won't be able to buy the dip, you won't be able to buy the bottom. You know,
Doesn't matter.
Forget it. You won't be able to try. You won't be able to do it. So, do it in increments. You know, and with all of everything we say today, that's probably a watchword people should take away, isn't it? You know, try to take out emotion from these decisions.
It's less important actually whether it's the right decision or the wrong decision, because as you say, you don't know. I mean, if the market goes up in a straight line from here and rises 20% over the next year, then obviously you want to put all your money in now. You don't want to hang around. But the beauty of doing things incrementally is it takes your emotions out of the equation, and that is always a good thing.
Yeah. Okay. The next question, Tom, is this: in Tom's 10-year fund picks, why has he not chosen any exposure to bonds?
So yeah, I mean, and a really important caveat about my fund picks, and I hope I've made that clear, is that while I have picked a group of 10 funds which I anticipate will do well over a 10-year period and have a certain degree of balance in there, a certain degree of diversification, they're not all my investments. You know, I personally, my own personal financial situation is such that I have, a wodge of money on one side, which creates, which prevents me being a forced seller. It creates balance in my portfolio. It lets me sleep at night, etc. And that totally changes the rest of the portfolio, where I've got invested in, actively managed, growth, probably more growth focused funds. There's a bit of balance in there. There's some value and there's some gold, etc. But it's not the whole picture. And I think that's really important.
And they're picks made with this, with a 10-year time horizon stretching ahead of you. Were you 5 years into that time horizon, or 7 years or 8 years, maybe the thinking changes.
Yeah. And remember, I'm still working.
Yeah.
In a few years' time, when I'm not working, then I will have a different view to the sensible balance of my portfolio. So all of these caveats are really important, and that, of course, is why it's why we spend a lot of time saying this is not advice, this is not relevant to your personal circumstances.
Yeah.
The reason we say that is because it's true. We don't know what people's personal circumstances are. My personal circumstances are totally different from other people's.
Yeah, and let's just dwell on the sort of conditions for bonds. There's a bit more of this coming in the next question as well, but we've seen in the past few days expectations for where interest rates will sort of level out fall somewhat, and that presumably is the market betting on faster interest rate cuts, slowing growth basically, and then rate cuts in response to that slowing growth. Is that fair?
Yeah, that's fair, and that, of course, is why bonds have done relatively well in the last week or so, because the expectation of where interest rates end up has shifted downwards, and bond yields and bond prices move in opposite directions. So that is generally good news for bonds. I think long term, and we talked about this earlier on, long term, there have been long periods when bonds have been rather a disappointing performer. And I think that that's sort of fixed in my mind. And so my diversification strategy has focused more on the security and safety of cash.
Well, that's it.
Than bonds. I kind of think of them in the same bucket, if you like. They're a diversifier away from the volatility and the risk of equity investments. So, yes, I don't. Yes, there are no bonds in that particular portfolio, but it's not like I haven't got that defensiveness.
Yeah. Okay. Well, let's move on for now, Tom. The next question is this: I'm managing my mother's finances. She's in a care home. Proceeds from the sale of her house are very dependent on UK interest rates. What are your latest predictions in light of Mr. Trump's activities? Please, we've just covered some of that, but yeah, let's.
Yeah, I mean, I think that the direction of travel for interest rates is down. It's probably not down as fast as maybe we thought not so long ago, and the reason for that is this stagflationary two-way pull. There's a two-way pull in the bond market because central banks are on the horns of a dilemma, really, because they have a twin remit to control inflation. Inflation is higher than they want it to be. That argues for higher interest rates to bring inflation down. They also have an obligation to support the economy and growth in the economy. Growth is looking weak and looking like it's going to get weaker. That argues for lower interest rates. Where do they go? The net result is while they have a look and see what's happening, they're probably sitting on their hands, and that's what's happened. The only central bank which is really sort of consistently bringing rates down is the European Central Bank at the moment. Both the Bank of England and the Federal Reserve are really just in wait and see mode.
Yeah.
But the expectations priced into the markets are for probably one more quarter point cut than we expected 10 days ago.
This year.
Yeah.
Yeah. I was.
That's quite a significant difference.
It is. Yeah. And I'll often look at the data that the Bank of England produces on the bond market yield curve. Complicated. I don't truly understand it, but from market prices for bonds, you can work out where the market expects rates to be. And you're right. The prediction for the next 9 months is really 3 quarter point cuts and then probably one more quarter point cut through 2026. So maybe in a year's time, we're about 1% lower on interest rates than we currently are. None of that's certain, obviously. The people will probably hear when they hear about the tariffs that they are inflationary. However, there's central banks seem to be indicating that they're not going to factor that inflation, if it comes along, into their rate decisions, i.e. keeping rates higher to combat that inflation. Jay Powell said, the chairman of the Federal Reserve has said that they would look through that kind of inflation, or it's transitory, or it will play out. That's a bit of an open question, though, isn't it?
It is, and the question is largely about the housing market.
Yes,
and of course that is, and the important consideration there is we're talking about interest rates here, but of course mortgage rates are determined in large part by bond yields, which are connected to interest rates, but it's not a like for like direct. If we are moving into a more inflationary environment, and also an environment where there is uncertainty about policy, it's entirely possible that bond yields will not fall as fast as interest rates fall, and that could mean that mortgage rates don't fall as much as maybe people would hope in terms of house prices. So I don't know the answer to what's going to happen to house prices. The most recent data earlier on this week was that house prices actually fell by more than expected between February and March. Part of the reason for that, of course, is that there are tax changes.
Yeah, there was a stamp duty.
There's been quite a significant stamp duty change, which has increased the amount of stamp duty that people, and that has hurt the housing market.
It pulled some purchases forward. I think people wanted to beat the end of the sort of stamp duty holiday sort of thing that was going on.
Exactly.
Okay, the next question, the penultimate question for today, Tom, is this. Tom, firstly, I really value all your input and advice and that of the team, so a huge thank you. Tom, my question is aimed specifically at yourself and is a very general question, but I'm sure I and others would be interested in your answer. It is this: over a 10-year period, what sort of percentage return would you find acceptable on your portfolio? I appreciate these Q&A sessions are generally aimed at market specifics, but hopefully you'll find a section where my question may be appropriate. Well, this is that section. What do you sort of what do you expect as an annualized return? It's actually a really good
It's a
question,
very good
this.
question. I'm really glad that that question came up, because I don't think we've ever had that question before.
Mm,
So how do I think about this? Well, what do I want the returns that I earn on my investments to achieve? The first thing I want to do is I want to keep pace with inflation. So I don't want my money to lose value over the long haul. So
hmm
if we assume that inflation, I mean the Bank of England's target is 2%, but let's say that they don't achieve that. Let's say it's going to be 3%. So I'd want my investments to make at least 3% just to stand still
hmm
in inflation adjusted terms. I would then obviously, they are uh, you are investing in the growth of the economy, so you would hope that there would be something to reflect just the fact that over time the economy gets bigger. Let's say
Yeah.
that's another 2 or 3%. um, you would then want to have something to reflect um, the fact that you're taking a risk with your
hmm
money. There's volatility. You don't know that all your investments are going to work out. Some companies are going to go bust. So you'd want something to reflect that. So let's say you want another 2 or 3% to reflect that risk. I think that brings you up to about 8 or 9% in
That would be
nominal
nice.
terms.
Yes.
That I think would be an acceptable return. That would be 5 or 6% in inflation adjusted terms, and that is not a million miles away from what over the long haul. If you look at these studies that UBS do one, Barclays do one, that go back over
hmm
125 years. That's not a million miles away from what stock markets have delivered over that time.
Yeah, I think that's a really good way to break that down because yeah, I think if people are new to investing, they can often see they'll often make a comparison with bank accounts, I think,
Mm,
and we'll say, well, I can get 4% in a bank account, so maybe a percent or two above that is acceptable.
mm,
But the way you put it there, probably you want compensation for the risks
mm,
you're taking. I would for my part, I would say things get interesting at sort of 6 to 7% in my I don't know. That's how I would put it in terms of the long term. If you get that kind
mm.
of return over very very long periods of time, what is your money doubles in 10 years with a 7% return. I
That's
think
right. Yeah.
so. When you
The rule of 72.
yes, your favorite rule,
Yes.
and at that sort of return, then you can start to think of actually like really significantly meaningful changes in your finances over long periods of time,
Yeah.
and capturing that actually is your job, I think, as an investor. We've spoken a lot about volatility and bad days being followed by good days. If you just take the approach that you just want to capture all of it, and historically you want to capture what markets have historically done,
Mm,
and you want to minimize your costs where you can and just get as much of it as you can and do it as tax efficiently as you can, that's enough, and that is
mm.
that is enough to make a really big difference to your financial security over a long period of time, and that's what the objective to investing should be.
It should, and you're right to mention the factor of time there, because you're saying it gets interesting at 6 or 7%, and you're right. And the reason it gets interesting is because the difference between the 4 or 5% that you might earn on a safe investment, like cash, and a 6 or 7% investment on shares, that 3%
Yeah,
difference rolled up over time, building on itself year after year after year for maybe decades, is why when you look at the charts,
yeah.
the jaws widen, and that's when you're right. That's when it gets interesting.
Okay, and we should just say, by the way, that um we're not saying any of that's going to happen or is likely to
No,
happen, in
we
terms of
don't know.
investment. So, if we publish, expect a 6% or a 7% return, that would be pretty punchy, right? I mean,
Yeah.
often when you see figures published for expected returns, it's a little lower than that. It's 5 to 6, maybe, but then you've got to take costs off. But obviously, people are cautious in their messaging around that, so for good reason. None of
Mm.
this is expected or guaranteed. The final question, Tom, is this: many times I've heard that 80% of active funds underperform. Is it much more risky to invest in an active fund rather than a market tracker that weights its investments as per the market percentages? Thank you, it says. So active versus passive,
Yeah.
a classic question.
Yeah, and it depends how you define risk. I mean, I think that the reality of actively managed funds is, yes, a high proportion of them do not even do
Hmm.
as well as the market. However, the averages are skewed by the small number which do considerably better than the market
Yeah.
average. And so the question you're asking yourself is, do I have a realistic chance of picking the funds which are going to do much better than the market as a whole? And I think that with sensible analysis and due diligence and an understanding of the approach of the fund manager, I think you can stack the odds in your favor of finding enough good funds to make active investment worthwhile. But I'm not sure that it should necessarily be the whole of your approach. And I personally have a mixed approach. I have some markets, some investments which are simply trying to track markets,
Yeah.
and others where I actually have conviction that this is a good manager, and over the long run, they'll have bad years, but over the long run, they're going to do better than the market as a whole. So I kind of keep it mixed.
Yeah, and I was saying before about kind of capturing the performance of the market. I mean, that is kind of my approach, and for that reason, I do towards passive investments.
Mm.
Um, but there's definitely times when active sort of makes sense to me, and I do have active around the margins. Um, the kinds of statistics that the questioner quotes there, 80% of active funds underperform. You need to understand the context to that because, and by the way, Fidelity sells both active and passive
Mm.
funds, but there'll be a lot of funds that are active out there with a higher cost than passive funds,
Mm.
and they're not particularly competitive. They're only really aiming, when you look under the surface, to basically track a market
Mm.
here or there, and they're always going to underperform because they've got a charge, whereas a passive fund, well, has a lower charge.
Mm.
So a lot of the market for active funds is that.
Mm.
It is hard, I think, to pick active funds with any certainty that are going to, well, you can't
It
have
is.
certainty that they're going to outperform. But like you say, you can understand when a fund is well managed
Mm.
and is sticking to its approach. There's
Mm.
ways to kind of objectively test that and
Mm.
assess it and monitor it. And if you're happy for the risk, because it's a risk that you underperform, but if you're happy to take that risk for the possibility of outperforming the market, and lots of investors do want to do that, they're not particularly like me, they
Mm.
want something potentially higher, then active is for them.
And just to flag up, how we approach that, we do it through our Select 50. And that is precisely what we are looking for with our Select 50. We are looking for well-managed funds that stick to what they say they're going to do, have a consistent process, a consistent investment philosophy. And we think that stacks the odds in our favor.
Yeah.
But they won't all work, and they won't all work all of the time.
Mm-hmm.
But we think that it's a consistent and a sensible approach to picking actively managed funds.
Okay. Well, Tom, on that note, let's leave it there because that is all the time we have now for questions. I'm going to say here that a full copy of Tom's investment outlook with charts, there's some videos that you've recorded as well,
Yep.
looking at individual asset classes. You're going to find all of that at fidelity.co.uk/outlook. But for now, we'll thank everyone for watching and listening. And Tom, thank you so much for joining me.
Thanks, Ed.